Hello, everyone. Welcome to Wall Street from Main Street podcast. My name is Mo Daoud, alongside John Manfreda, and today's guest is a returning guest, John Rubino. John Rubino is the editor of DollarCollapse.com, and he's also the co-author of The Money Bubble, which he wrote with James Turk. John, thank you for coming back.
Hi, Mo. Thanks for having me on. And hi, John. Good to meet you.
Thank you. Same here. First topic I wanted to get into, you wrote about a auto loan bubble. Right now, I looked at Ford's news today, and it said it will miss the target profit for the year 2014. I have a question. Do you think this auto loan bubble is going to come sooner rather than later, or is it still just we don't know when bubbles will pop?
There's no way to know when bubbles pop, unfortunately. You could make a lot of money if you could predict the timing of the bursting of all these bubbles that we've had for the last 3 decades. And the auto loan bubble is one of the smaller ones. It's not as big as housing and certainly not as big as tech stocks. But what has happened lately is that for some reason we've, in the financial community, we've fixated on auto loans, and all of a sudden loans are getting really easy for people who buy cars to get. And so whereas back in 2006, let's say, you could get a house, you'd get a home mortgage if you had a paycheck and a heartbeat, and now that's true of cars. And so people are taking out really expensive long-term car loans that in the past they probably wouldn't have qualified for. So now auto loans are becoming the new growth sector in the junk finance market. It's been student loans up till just lately. Actually, they're still growing, but they're not growing as fast as auto loans now. So student loans surpassed credit card debt at a little over $1 trillion a couple of years ago. And now auto loans are headed for that same $1 trillion mark. And what this means is that we're basically looking around for new sectors of the economy to leverage because we're grossly over-indebted. We can't grow without taking on more and more debt, and there aren't that many people left to lend money to. So the car buyers are now the subgroup that is getting the attention from banks, and getting the easy money. And this is going to end the way all the other bubbles have ended, basically, with people getting grossly over-indebted, unable to pay their bills, defaulting, and basically handing their cars back to the lenders. So there are strong sales today, but we're basically taking sales from the future in the present, and that will be reversed out at some time in the not-too-distant future. So the real question is, because this is guaranteed, this is definitely going to happen, but the real question is, will this be a catalyst that causes a bigger financial crisis out there? Because that's, I think, the interesting question now is what's going to do it? Because we know something big is coming. We've borrowed so much money, and we didn't learn any lessons, apparently, from the 2008-2009 crash. We just reset the financial system with a bunch of bailouts and then turned it loose again to start leveraging itself. So bank derivatives books are higher than they used to be. We now have going on a quadrillion dollars of face value in derivatives now, and we've got student loans at record levels, and now car loans at record levels. So something is going to happen in the financial system based on history. Whenever you get to this point, some really serious crisis erupts from somewhere. And the question is, what will do it? What will be the snowflake that sets off the avalanche, or the straw that breaks the camel's back, or whatever? And eventually, that's going to happen. We just don't know when.
And we can thank the Federal Reserve for causing this somewhat bubble occurring in the auto industry, because without their endless money printing and zero interest rates, none of this would be happening. And this seemed to be a pattern for the past 2 decades, where every time the economy goes through a glut, the government starts a bubble. We started the tech bubble in 2000, and once that crashed, they started a housing bubble that lasted for a couple years until 2007. And that crashed, and now they're starting a bond slash college slash auto loan bubble now, and that will soon collapse as well.
Yeah, the original name for the idea that the Federal Reserve was going to bail out market speculators whenever they got into trouble was the Greenspan put, meaning that if there was a financial crisis, don't worry about it because the government was going to come in and fix it for you if you're a big bank. So you didn't have to worry. You could lend as much money as you wanted to anybody, basically. And that, the genesis of that idea is in the early and mid-1990s when there were a series of crises. That Mexico defaulted on its debt, and Russia defaulted, and we had the Asian contagion when there was a financial crisis in Asia. And in each case, and the long-term capital management blow up. So in each case, the Federal Reserve stepped in, lowered interest rates, flooded the system with cash, and basically made good the people who would have been wiped out by those crises had the markets been allowed to work. And so the global financial system learned the lesson from this, that it's okay to speculate, that you can basically leverage yourself to the hilt and keep all the profits that you make, and if you happen to guess wrong and lose, the government will fix it for you. And so that's basically been what we've been doing ever since. And the biggest example of that was 2008, 2009, when the big banks made so many bad bets that they would have all gone bankrupt. You know, J.P. Morgan Chase, Citigroup, Goldman Sachs, they would all be gone now if the government hadn't stepped in and bailed them out. And they gave them banks so much money that the banks actually got richer, and the executives actually got bigger bonuses the year after the bailouts. So they made it not only like it never happened, they made it better than if it had never happened for the big banks. And so we're right back at it again, only on a bigger scale.
Yeah, you can definitely see a pattern. If you look at the crisis, it started with the '87 stock market crash, followed by a much bigger tech bubble, followed by a much bigger housing bubble. And now it looks like we have a housing, auto, and currency, as your book called, a money bubble all in one. And it seems like what you said is that they're bailing everyone out. They're not letting a failure occur. And in order to have a healthy, sustainable economy, you have to let people, in my opinion, you got to let them fail. You have to let businesses go under, and not only that, in terms of banks, there is some problem, but it goes back to making sound decisions. You got to know who you're depositing your money with, and what the risk and liabilities you take by depositing. Most of those dollars you put into a bank, they're not really there. A lot of them are loaned out. And we can't just keep subsidizing reckless behavior with it.
Yeah, the interest rate is basically the price of money, and that's a crucial signal that the market sends to buyers and sellers and investors and savers. And when the government forces interest rates down to unnatural levels, that sends a distorted signal to the market. So it causes people to do things that they wouldn't normally do, and that in a lot of cases they really shouldn't do. And that's called malinvestment. When factories get built that shouldn't be built, and houses get built that are too big for the buyer, and all the rest. People buy cars like they're doing right now that they really can't afford. All of that stuff distorts the economic system and makes us poorer rather than richer, because these investments don't pay off. They don't generate the cash flow that they need to cover the loans that were required to make the investments in the first place. And so what the government is doing now is sending a massive number of bad signals to the market. And it should be no surprise that you've got all this weird stuff going on out there, incredible amounts of speculation in various markets that then blow up. And as you said, it's been going on since the 1990s, but actually the 1980s, because the junk bond bubble was the first one. That's where I had my first job in finance. I was a junk bond analyst back in the late 1980s. And so I saw firsthand what it's like when a bubble expands and then pops. And since that time, we've been doing the massive bubble blow-up thing on a once-a-decade cycle. So we're now at the point where we've blown up a bunch of new bubbles. Equities around the world are at levels at which they have, in the past, subsequently crashed. and high-end real estate is at record levels, and fine art is at record levels. And so the only thing that hasn't gone through the roof in that category, in the category of hard assets, is precious metals. So I think at some point they're going to get taken along with the rising tide of hard assets. But in the meantime, you've got all these other asset classes that are very bubblicious right now. And so at some point, one of them will pop and pull down the rest. And so now it's just it's just a question of the timing from the point of view of investors. Because you can lose your shirt by betting against a bubble. If you're a year too early, then the asset class, whatever it is, can double on you before it finally pops. And so you have to be very careful. When I say, oh, the bubble's going to pop, doesn't mean it's going to pop next week. And so you don't want to bet the rent money that that's going to happen. But what you do want to do is pay attention and start looking for an entry point and be prepared to commit capital when the time comes, when you're convinced that the bubble is ready to pop. And if you do it right, you'll be one of the people who make a ton of money, because in each of these bubbles bursting, there have been people who bet against the bubble at the right time and got very rich. John Paulson is a good example in the last cycle. He's a hedge fund manager who bet against the housing bubble and made $20 billion for his hedge fund in the space of a year. So on a smaller scale, it would be nice to be one of those people. So I think that's the intellectual challenge that faces investors right now, is not deciding that the bubble is going to burst, because it is, but timing it. Trying to figure out when you want to place that bet, put your money where your mouth is.
And the auto industry would be a great shorting candidate for any investors or traders out there that's looking to take advantage of the various bubbles that's going on in the current economy. I mean, other than the restaurant industry, I think the auto industry is a good shorting candidate for anybody.
Yeah, there is definitely no shortage of short candidates out there, because, the restaurants have looked really scary to me for a long time, because we've had food inflation that has exceeded the overall rate of paycheck increases in the U.S. So that means for the restaurants, they have to raise their prices at a rate that exceeds the rise in the incomes of their customers. So you would think that's a recipe for disaster, right? But it hasn't happened. The restaurants have been holding up pretty well. And same thing with the car companies. They're still selling a lot of cars, but as we said before, they're buying or they're purchasing growth today at the expense of growth tomorrow. They're going to grow more slowly in the next 3 years than they did in the last 3. And that will probably come back to bite them. But timing of all this, maybe the auto bubble goes for another 2 years. Who knows? But if it does, then that means the crash, when it comes, will be pretty horrendous. The car companies will really be left high and dry by 2 or 3 years of declining sales. And that'll be terrifying for them, bad for the car dealers, and great for the people who short the car companies, and great for car buyers. We'll get some great deals out there in 2017 or whatever.
Yeah, definitely. And the behavior that's going on in the bubble, whether it's the auto bubble or the housing bubble, as you mentioned before, it's very similar. Like, we have a lot of speculation on Wall Street, and then also the people that part of the bubble, like the car manufacturing companies, the credit score agencies. Like, for example, FICO. I don't know if you know this, but FICO manipulated their credit score industry and changed it so that anybody that has missed a payment on their bill or settled with a collection agency is no longer part of the formula for calculating a credit score, which inflates it, make it look better than it really is, which makes more people more eligible for a car loan when they're really not, or even mortgages as well.
Yeah, I did see that. I actually wrote something about that. It's a fascinating peak of the bubble kind of story, where they made some changes in the way they calculate credit scores in order to raise people's credit scores, in order to make more people eligible for loans. and the implication is that the banks aren't actually paying attention to any of this. They're just looking at the credit score. So they don't care what the credit score actually means. They just need to justify their loan decision by pointing to a credit score at a certain level, and then they can then sell those loans to repackagers who turn them into asset-backed bonds because the loans conform to the criteria of the packagers. And so it's all kind of on autopilot. And it's reminiscent of what happened back in the days of the housing bubble, when lending criteria, lending standards, got more and more lenient year after year after year, until they were just shoveling money out the door. You know, anybody with a heartbeat could get a loan back then, and it's becoming that way in the car industry now. So yeah, you know, another thing you can short is these bonds that are being created out of these auto loans. I think those things will be phenomenal catastrophes at some point. And the guys who are sophisticated enough to figure out which ones are which and to actually do the shorting, because it's not easy technically to do that, will make a lot of money at some point.
Yeah. I wanted to switch also topics about speaking of another bubble to the housing market right now. And right now, I would say lately, today's home prices year over year, that missed expectations. It did rise. You saw pending home sales that has declined. And as we're tapering, you see the Fed drawing back their mortgage-backed securities. Do you see a possible housing bubble? Like, I personally think this one might end up worse than the last one, just because you have people buying all cash now, treating it like a stock. And if there's any type of price decline, they might treat it like a stock and just sell it immediately and cut their losses. What do you see right now currently at the housing market? Do you agree with my assessment, or is some tweaking needed?
Well, the investor angle, you know, all these houses that were bought for cash is new. And so we can't know how these guys are going to perform if housing turns down. But yeah, there's a real possibility that they're going to be more likely to just cut their losses and sell, you know, just liquidate, than would a big aggregation of homeowners who don't want to sell if they can help it. And so I don't know about that. I think it's a possibility that that exacerbates a downturn when the time comes. And right now, housing really isn't. See, tomorrow's bubble is never yesterday's bubble. You know, you have to wait a few cycles for the last bubble to become the central bubble in a new financial mania. And since housing was the last one, the financial system has looked for other hot asset classes to throw reckless money at. And it's been student loans and car loans so far. That said, some markets in housing are getting back to bubble levels. You know, there's some places in the West that are just raging right now. And I think Manhattan and Brooklyn are really, really hot. But it's not a national thing the way it was in 2004, 2005, 2006. You know, back then, there weren't very many places left out of the mania, just because housing had been nationalized, in effect, by the securitization business. You know, you could write a loan anywhere, then sell it to Fannie Mae, Freddie Mac, or one of the over-the-counter guys, you know, the independent guys, and they would turn it into asset-backed bonds and sell it to hedge funds and to pension funds. And you know, that's not really raging the way it was. You know, housing is coming back in some markets and not in others, and overall it's kind of flat. If you look at the national housing statistics, they started to turn back down in terms of sales last year, and we've had something like 10 straight months of negative sequential growth. So I think housing may be more of a slowdown story at some point. It'll be one of the things that pulls down the rest of the economy, especially if the private equity guys who bought up all the houses for cash start to sell some of them. So I don't think that's going to be one of the catalysts for the bursting of the money bubble, you know, but I think it could be a contributor when the time comes, when something else blows up. And then people start looking around for where else there's trouble, and they say, oh, yeah, housing is starting to turn down too, and that adds to the angst. So that's probably what housing's role is going to be this time around.
And we live right outside the D.C., or Washington D.C. in the D.C. metro area, and we still going through a housing bubble in this area. I mean, there's condos, luxury condos, still being built and sold. Townhouses and homes are still being built in this area and sold. And when the bubble crashed, this area took a hit, but wasn't as bad as what you saw in California, Detroit, or even in Florida. So I think once we had the bomb bubble go out, I think areas like this area, the Washington D.C. area, will get hit hard this time, mainly because when it's a bomb bubble exploded, that means the government's in trouble, can't pay the bills, and that's going to be a domino effect for the housing bubble.
See, that's the thing. Normally, D.C. is a counter-cyclical market because in hard times, the government gets bigger. And so that means you've got more bureaucrats and more lawmakers and their staff and everybody moving in and wanting to buy houses. And in the last few years, the government has grown to gargantuan proportions. So that explains the boom in Northern Virginia and the D.C. area. And yeah, it would be nice, not that I want your houses to go down in value, guys, but it would be really nice from an ideological standpoint to see the D.C. housing market crash, because that means the government is getting smaller. And we haven't seen that in a really long time. I don't know when the last time D.C. was a depressed housing market, but the time is coming. As you said, the government will eventually run out of money. And when that happens, a lot of this overinflated real estate in the D.C. area will crash. And I just for ideological reasons, I'm looking forward to that day.
Then also we have a housing bubble here, then Congress and all the senators will start to feel the pain of what the middle class went through 2008 when the housing bubble crashed in the U.S. in general.
Yeah, they should feel our pain.
Yeah, then they'll never do it again, hopefully.
Yeah.
So let's stick to the topic of the economy. I have one additional question, then maybe we can shift to gold and silver. And I don't know if you noticed, but the Apple 6 came out, and one of the features that it had was called Apple Pay, where people can pay for their groceries or the services or good they buy electronically without using cash or even a credit card. And so that's being introduced. And then also you consider the rise of cryptocurrency like Bitcoin. Do you see our society becoming a cashless society where money paper is no longer being used?
I think the governments of the world would like that, both because cash is used in criminal activities and because a cashless society is a lot easier to monitor, and it is a lot more convenient to be able just to click buy on Amazon or wherever and have whatever you want delivered to you. So I think we're tending towards a cashless society. And by the way, cryptocurrencies like Bitcoin are accelerating the process because it's giving people a new incentive to buy online and to transact online rather than carry cash to a given place and hand that cash over. But I think there will always be a role for cash. At least I hope there will be, because it is private. And we don't have many areas of privacy left to us. So I think the idea that every single financial transaction of ours is going to be tracked by Google and via Google, the government, is a scary thought to me. So I'd like us to have some ways of transacting, of buying and selling, and being able to do it without someone looking over our shoulder. So yeah, we're heading towards a cashless society, but I hope we won't ever get completely there.
Yeah, my question about a cashless society is a lot of people talk about paper money not having value, but I was going to say, as someone, a while back I used to teach DC public schools, so I know a little bit about, just handing stuff over without getting caught. And I see cash being a lot easier than gold and silver as underground barter. do you think cash could carry a premium if we ever went into a cashless society? Now, I know you don't know for sure, but just in terms of a guess, like, could you think an unintended consequence of a cashless society make cash actually a premium?
Yeah, there might be a black market in cash, but I tend to think by the time we get to that point, these fiat currencies are going to be a lot less valuable because they're currently being inflated away at an ever-increasing rate. And when and if we get to the point that governments are so powerful that they believe they can just declare cash illegal, then I think the black market in money is going to be primarily in gold and silver, because that's going to be perceived as real money that doesn't depend for its value on the government maintaining the supply. And so, and I hate this scenario. I hate the idea that we might get to a point where there are extensive black markets because there's so much control, from the top on the economy. But you never know. And in the rest of the world, for instance, Argentina right now and Venezuela, there are black markets in currency, and sound currencies, relatively sound currencies in that scenario, like the dollar, tend to trade at a premium. But then so do gold and silver. So I think that the ultimate black market is going to be in precious metals, which are real money, as opposed to fiat currencies, which are fake and are, headed for history's trash heap at an accelerating rate.
Now, let's shift gears here and finally talk about the gold and silver market. Now, lately the demand for gold and silver has started to pick up a little bit. We're seeing a increase in the American gold sales has increased in the U.S. They sold nearly 50,000 ounces in September so far, which was almost double the total in August. And also we're seeing global demand increase in China and in India mainly because of the wedding season, but in general the demand for India has always been strong in the past few years. Yet we're still not seeing anything happening in the prices of gold and silver, mainly because I think the paper market is overwhelming the physical market as of now. So are you surprised that gold and silver has been staying down this low in prices for this long?
Yeah, I really am, because the macro world right now, most of the fundamentals out there are screamingly bullish for precious metals, because you've got basically all the major governments of the world either engaging in really aggressive debt monetization like Japan, or beginning to do it like Europe, or ending the old program and probably going to have to start a new program like the U.S. So there's really no end in sight to the really aggressive money creation that has to happen to service our debts, because you take away the punch bowl, you let interest rates rise to normal levels, which would be 6% on a 10-year Treasury bond in the U.S., for instance, and the whole world is bankrupt instantly, because everybody has borrowed either short-term, which means they have to roll their debt over every year or two, or via variable rates, which increase and decrease pretty much instantly with the rise and fall of interest rates. So let interest rates go up, and everybody's interest costs go up at the same time. So all this progress on the budget deficit and on consumer finances and household net worth, all of that will be wiped out if interest rates begin to rise to normal levels. So we have to keep interest rates down, and to do that, we have to pump out more and more money into the system. We've got to make money cheap by increasing the supply. So that is baked in the cake. We can't get away from that. As Doug Nolan at Prudent Bear says, it's now inflate or die. And so that kind of a situation is really theoretically bullish for gold and silver, and yet gold and silver are just getting whacked. So the only thing I can think of is two possibilities. One is that there's aggressive manipulation going on, in which the governments of the world and some of the big commercial traders are each in their own way for their own reasons, forcing down the price of precious metals. The other is that the markets might be perceiving that we're heading for a deflationary crisis before we get into the next stage of active inflation. So, and that's, that's believable, because Japan is dropping into a recession. Europe is dropping into what looks like a really serious recession with deflation, where their prices start to go down. And the U.S. has been growing modestly lately, but it's showing signs of slowing down, even though the GDP report was higher than people expected just lately. There's a lot of other reasons to look for a slowdown in the U.S. So it could be that we're going to have a 2008-style deflationary shock before we have the 2010, 2011, 2012 really aggressive quantitative easing programs around the world. And that would be bad for gold and silver in the short run. But that previous crisis was also really good for gold and silver in the long run because they soared once all the governments of the world made it clear that they'll do anything it takes. They'll print as much money as it takes and bail out whoever needs to be bailed out to prevent a descent into a 1930s-style debt-driven collapse. So once they make that clear again, if that's what we're heading into, then gold and silver will just rocket. So I'm not worried in the long run, but I don't like this in the short run.
Yeah, I definitely see in the short run anything can happen. In terms of the manipulation, it seems like no matter what the news is, what the data just keeps going down. But lately, as we said, we were talking about how the coin sales are the highest they've ever been. Do you think right now, as someone who works in the retail industry, I don't see it making it over to the retail side in the U.S. My question is, if you had to guess, who do you think these buyers are? Do you think they're retail in Asia, or maybe they're a central bank, or whatnot? Well, who would you guess is buying?
Well, I really don't know, but if it's not retail buyers, then it's higher-end buyers. And there have been reports lately that large gold bars are being snacked up at a triple-digit percentage increase over last year, and that would be the 1% shifting some of their money out of equities and bonds and into precious metals. And it could be that coin buyers are the same people. Maybe they're buying across the size spectrum in precious metals, and I really don't know. And so it'll be interesting to see if the surging numbers that we're seeing from the mints translates eventually into higher demand at a retail level in the U.S. I don't know. We'll have to see how all this goes. But at least the mint sale numbers are encouraging. And if they do end up being sustained, that means there's demand somewhere. Somebody's buying a lot of this stuff, and that's a good thing in the long run for precious metals. Yeah,
I was going to say, I definitely agree. I just know this from my day job. I work with Perth Mint, and I know their biggest client is China, and it says right here on your site, Perth Mint gold and silver bullion sales surge. So I definitely see that as China is definitely still buying, and if China's buying, and they're the largest holder of dollars, there's got to be a reason.
Yeah, that's really encouraging that China's buying seems to have picked up lately, because it was massive last year and then trailed off a bit this year. But if it's picking back up, that's the dominant force in precious metals right now in terms of physical, because last year, China, Russia, and India, between them, bought more gold than the world's gold mines produced. And where did that extra gold come from to make up the difference? It had to come from the central banks in the West, who were running through their reserves without telling anybody about it and then shipping it east. And so another year like that brings us closer to the day when the central banks in the West have to admit that they don't have the gold they said they did, and that at some point they're going to have to stop shipping gold east because there's no more gold left. And we don't know when that's going to be because we don't know how much they've shipped so far, but the numbers last year from China and Russia and India were big enough to imply that we're getting close. If you're shipping thousands of tons of gold out of your reserves, no matter who you are, you're losing a big chunk of the only real money that you've got in your reserves. So that's the kind of thing that can't go on forever. And when it comes to light, it'll be nuclear bomb hitting the gold market. It'll be amazing what that realization does to the price of gold and silver. When we find out there really isn't as much as we thought, now then there'll be a scramble to buy what is left.
And with the shift, and I'll say the shift with the physical market going from west to east, that's also an indicator that the days of the U.S. dollar being a world reserve currency coming close to an end, because look how all the other countries are trying to set themselves up. They're buying all the gold. They're doing deals outside the petrodollar system and outside the U.S. dollar system. And so the trend, it looks like the trend is going to be that the U.S. dollar, at some point in the future, will no longer be the dominant currency for trading. So we're heading to an interesting time, thanks to the Federal Reserve and the U.S. government.
Definitely. The rest of the world is kind of tired of us having the world's reserve currency because we've really abused that privilege, in the U.S. And you see China and Russia and India and Brazil and France and Germany, actually, all taking steps to use other currencies besides the dollar and let the process accelerate. And at some point, the dollar loses its status as the central world's reserve currency. It becomes just one of many. And that's a huge change. The dollar's not worth as much in that scenario as it is today. So when it happens, that will also be a huge event for the U.S. So there's a lot of things coming out there, any one of which could completely change our perception of the market and of normality.
Yeah.
Well, John.
I was just going to ask one more question. I've read from some people that in terms of gold, the remonetization, do you see that coming in the future as settlements being traded in gold are a partial world reserve currency or remonetization?
Yeah, that's certainly possible. I mean, they've done a bit of trading in the Middle East of oil and food for gold already. And one very reasonable scenario, and this comes from Jim Rickards in his two books on currency wars and the death of money, that everybody's trying to devalue their currency against their trading partners' currencies, which is really a zero-sum game because you help yourself but you hurt them, and then they turn around and they hurt you by devaluing their currency. And everybody's going to eventually figure out that one thing they can devalue against is gold, and everybody can do it at once. And so you get this huge burst of inflation when everybody sets their currencies, pegs their currencies to gold again. And for instance, in the U.S., it might be $10,000 an ounce. So the dollar becomes a name for 1/10,000th of an ounce of gold. And that's great if you own gold, terrible if you have a bank account denominated in dollars, because your dollars automatically become worth 1/6 as much as they were the day before that happens. So, it seems reasonable. It's happened before in history, and I think that's the least chaotic way for this to resolve.
Well, John, I'd like to thank you for coming on Wall Street for Main Street podcast. If people want to find out more about what you do and your work,
I run dollarcollapse.com, which is updated daily with the stuff we talked about here. And my most recent book is The Money Bubble, co-authored with Gold Money's James Turk, and it's available on Amazon.com and any other electronic bookstore.
I recommend people read that book. It's an excellent read. Well, John, thank you for coming on, and hopefully you can come back on again soon.
If you're tired of losing money with your financial advisor, want to ask better questions to your money manager, or would like to learn to invest on your own, Wall Street for Main Street can help you. Our goal is teaching people how to fish for themselves instead of trusting their financial advisor for everything. Wall Street for Main Street offers high-quality investor education, market research, and consulting for beginners, high net worth clients, and anyone else in between that wants to learn to adapt to the current macroeconomic situation, profit off of it, or hedge themselves. Please contact us at wallstreetformainstreet.com. That's WALSTFORMAINST.com for more information. Also, if you love our podcast and website and would like to donate money so you can continue to get exclusive podcasts from top experts, CEOs, economists, authors, and all of our great guests, please go to our website to donate money, go to our Indiegogo page, or go to our iTunes page and give us a great review. We accept donations in fiat currency, Bitcoin, and also precious metals.